They are calling it the boldest shakeup in Japan's financial history. That was the exclamation echoing across Tokyo's vibrant business district when news broke that Japan's financial services agency intends to classify cryptocurrencies as financial products. How, you might ask, did those digital coins that once drifted on the fringes of niche tech communities end up at the center of a potential regulatory revolution? Today we are going to find out. We will delve into how this proposal took shape, why it is being introduced right now, and the far-reaching consequences it could have for every investor, dreamer, and skeptic who has ever wondered what the future of money might look like. At the heart of this upheaval lies the Financial Instruments and Exchange Act, the backbone of Japan's securities and financial products regulation. Cryptocurrencies now stand at a pivotal crossroad, poised to exit the realm of the Payment Services Act and step onto the more comprehensive stage of the Financial Instruments and Exchange Act. This shift is not just a mundane bureaucratic update, it represents a massive transformation that could reshape how Japan manages digital assets, including the prospect of launching crypto exchange-traded funds, lowering taxes on crypto gains, and welcoming brand new participants into the market. In this whirlwind of uncertainty and optimism, we will tackle several pressing questions. What exactly does Japan's new capitalism strategy have to do with digital coins? Why might the capital gains tax on crypto dwellings fall from a steep 55% to a more attractive 20%? And how is the Bank of Japan responding to the unstoppable digitization that seems to be rewriting the world's financial scripts? So, strap in. In the next segment, we are going to explore the driving forces behind Japan's ambitious regulatory proposal. We will examine the mindset of Tokyo's financial leaders, the unstoppable rise of crypto adoption in the country, and the global influences that helped formulate this proposed legal reclassification. We will take a good, unflinching look at the motivations and controversies surrounding what continues to be one of the most dynamic, future-forward industries on the planet. First, let us rewind just a little. It might feel as though crypto exploded overnight, but the seeds of Bitcoin, Ethereum, and other digital assets were planted well over a decade ago. However, up until a few years ago, many conventional financiers and legislators wrote cryptocurrencies off as a temporary fad. Today, regulators are singing a different tune, and Japan is no exception. Over the past several years, Japanese regulators have warmed to crypto, not necessarily rushing out to champion it, but recognizing that ignoring it is no longer an option. The Payment Services Act in Japan was among the first legal frameworks globally to attempt to define and manage cryptocurrencies. At the time, it seemed progressive. Finally, there was a robust definition and guidelines for exchanges to prevent money laundering and protect users. But that initial perspective soon began to feel outdated as currencies like Bitcoin and Ethereum gained a broader economic role. In stepped the Financial Services Agency, meticulously studying the evolving landscape. Now, the FSA has put forth a radical proposal to shift crypto oversight from the Payment Services Act to the Financial Instruments and Exchange Act. Why is this so monumental? The Payment Services Act mainly tackled the mechanics of payment and settlement, focusing on crypto as a means of exchange. The Financial Instruments and Exchange Act, on the other hand, places cryptocurrencies in the same category as securities and other financial instruments. This classification would open the door to exchange-traded funds and other advanced products that hinge on digital assets. No wonder so many experts have declared, this changes everything. After all, the FSA's move is not just about scribbling new definitions into a rulebook. It signals to the world that Japan wants to treat crypto like a genuine investment-grade product, on par with stocks and bonds. And if crypto is recognized in this way, the financial realm will be ushered into an era where digital assets could just as easily underpin sophisticated products like mutual funds or derivatives. But let us not forget that a proposal of this magnitude inevitably stirs debate. Opponents mutter that lumps of code should not mingle with mainstream securities. Meanwhile, supporters hail this push as exactly the kind of modernization Japan requires to remain at the forefront of a technology-driven world economy. Even if you are not a finance buff, you can see how the mere rumor of a new classification has triggered excitement and possibly a hint of fear among those who see cryptocurrencies as disruptive forces of change. Before we plunge deeper, here is a quick call to action. If you find this journey into Japan's crypto frontiers intriguing, show your support right now. Take a moment to like this segment, as it encourages us to continue uncovering big shifts in the global financial landscape. These transformations can seem labyrinthine, but with your support, we can keep shining light into all those hidden corners. Now, let us take a hard look at the motives fueling this regulatory metamorphosis. The FSA's timing aligns remarkably with Japan's new capitalism strategy, an initiative that aims to energize the nation's economy by making it more investment-oriented. For decades, Japan was known for its conservative approach to monetary disciplines and a tradition of emphasizing savings over investments. Yet in recent years, leaders have recognized that to remain competitive on the world stage, Japan needs to harness the power of financial innovation. Cryptocurrencies, with their promise of decentralized ownership and innovative technology, present a golden opportunity to do just that. By introducing regulations that acknowledge digital currencies as legitimate financial instruments, Tokyo's leadership hopes to galvanize foreign investment, empower local industries to experiment with advanced financial tools, and position Japan as a center for forward-thinking enterprise. Far from being a rash decision, this dovetails with a broader recognition that investment, not merely stoic saving, is crucial to revitalize the economy. Nevertheless, not all government measures evoke immediate cheers. Some citizens, especially the older generation, see the loud buzz around crypto more as a speculative mania than a measured, well-reasoned market shift. At the same time, younger tech-savvy individuals have found solace in digital assets, citing the chance for wealth building, financial independence, and a sense of participation in the next wave of technology. It is not just about trying to make a profit, some say. It is about not missing history in the making. Where does the FSA's move fit into this generational tug-of-war? By leaning in favor of crypto, the agency seems prepared to address the concerns of both camps through regulation. On one hand, it aims to ensure security, transparency, and accountability, appeasing skeptics who fear losses and scams. On the other, it positions crypto as a recognized financial product, offering a sense of legitimacy that could motivate even the more cautious investors to participate. Balancing these opposing viewpoints will be a delicate process, one that the FSA is determined to manage. Another reason for the reclassification is undoubtedly the question of taxes. Under the current regime, capital gains on crypto trades could be taxed at up to 55%, which is a staggering rate that can put a damper on enthusiasm. The newly proposed shift to a flat 20% is more or less in line with the tax rate for stocks, which signals that Japan means business when it says it wants to integrate crypto into its broader financial system. This proposed tax cut has garnered an almost jubilant reception from crypto enthusiasts. They see it as a sign that the nation is genuinely committed to unshackling the digital sector from unwieldy burdens. That said, plenty of critics argue that the government is effectively rolling out the red carpet for speculation. Sure, slash the taxes, they say, but what if we see rampant gambling instead of genuine investment? The FSA's response has largely been that responsible investors will be protected under the new framework because of stricter oversight. But the debate is far from settled. In fact, even those who wholeheartedly support crypto in Japan are urging caution. While a reduced tax rate might attract new participants overnight, it could magnify hype and short-term mania if not carefully regulated. Skeptics bring up the roller coaster journey of Bitcoin's price history, reminding everyone that times of frenzied enthusiasm can just as quickly swing to moments of crushing panic. According to experts, a robust regulatory environment combined with a fair tax policy might mitigate wild speculation, but the best approach remains to watch carefully. That said, this entire conversation goes beyond mere speculation on coin prices. The reclassification under the Financial Instruments and Exchange Act could spark the creation of crypto-based exchange-traded funds, ETFs that directly hold digital currencies. If that becomes a reality, Japanese investors could buy, sell, and hold cryptocurrencies through official brokerage accounts rather than relying on specialized exchanges. Analysts predict that such a development might flood the digital market with liquidity, as institutional funds and everyday investors find it simpler and more convenient to hop on board. Similarly, a properly regulated crypto ETF market would likely halt some of the unscrupulous behavior that can plague certain corners of the digital space. A common critique of crypto is that shady operators and hackers can exploit vulnerabilities and vanish without a trace. A regulated ETF structure, pinned under the watchful eye of the FSA, could potentially minimize those darker aspects, making it more akin to conventional financial investment channels. Here is the global perspective. The idea of listing crypto ETFs is not entirely new. Other major economies, including the United States, have already ventured into the realm of Bitcoin and Ethereum ETFs. According to data from March 2025, the FSA notes that more than 1,200 financial institutions in the United States have dipped their toes into spot Bitcoin ETFs, including big names like major pension funds and Goldman Sachs. Japan, historically recognized for its forward-looking approach to technology, does not want to be left behind. This objective to catch up offers a rational impetus for the country's regulatory shift. At the same time, Tokyo's quest to remain a leader in tech is partly fueled by surging crypto adoption within its own borders. As we inch further into 2025, it has been revealed that more than 12.1 million domestic crypto accounts are active. The total value of crypto holdings on local platforms exceeds 5 trillion yen, a figure that makes even the most jaded market analysts perk up. What may feel especially surprising to some is that Japanese crypto ownership has even outpaced participation in more traditional financial instruments, such as foreign exchange trading and corporate bonds. This phenomenon can be partly attributed to a younger demographic that is increasingly tech-savvy. Many see digital assets, whether Bitcoin or an obscure altcoin, as a path toward financial freedom in an otherwise notoriously conservative economic climate. For years, critics assumed that crypto was too risky for risk-averse Japan, but the data is flipping that assumption on its head. The prospect of bridging generational divides, older folks rallying around stable, historically proven investments while younger investors embrace the digital world, undoubtedly requires a skillful balance of forward-thinking policies. Another puzzle piece in this story is stablecoins, which are digital currencies meant to mirror the value of fiat money, such as the Japanese yen or the US dollar. Japan has showcased its willingness to pioneer stablecoin regulation, having become one of the first countries to issue a license for handling stablecoins under updated legal frameworks. A prime example is SBI VC Trade, a subsidiary of SBI Holdings, which not only received approval to handle stablecoins, but also signals its intention to support Circle's popular USDC. This development places Japan at the vanguard of stablecoin acceptance, further reinforcing the country's emerging reputation as a pro-crypto environment. Yet, there is a subtle tension swirling beneath all this optimism. The Bank of Japan, a dominant force in the country's financial sphere, has cautiously flagged the possibility that in a digital future, trust in traditional legal currency could erode if central banks fail to maintain stability. Deputy Governor Shinichi Uchida's remarks served as a wake-up call. If the younger generation, raised on smartphones and digital payments, finds fiat currency outdated or unreliable, they might turn wholeheartedly to crypto or stablecoins as a store of value. In such a scenario, the entire global monetary system might look drastically different in a few years. Dwindling reliance on fiat currencies would place enormous responsibility on central banks to keep at least some pace with technological leaps. This is precisely why the Bank of Japan has been experimenting with the idea of a central bank digital currency, trying to modernize the yen's infrastructure so it remains relevant. Meanwhile, the FSA's reclassification proposal could dovetail with these modernization efforts. Surprisingly, major corporations are increasingly open to the changes the FSA might put in place. Technology giants and insurance providers alike are quietly exploring ways to integrate digital currencies into their operations, from using stablecoins for settlements to tokenizing equity or real estate. Watching these large institutions pivot is reminiscent of a grand chess match, and investors with a nose for opportunity are keeping a keen eye on the moves being made. The outcome might reshape the fundamentals of how financial transactions function, not only for Japan, but potentially for regions influenced by Japan's economic leadership. Critics, of course, remain. Some worry that if Japan normalizes crypto in the national psyche, unscrupulous players from around the globe may swarm, seeking to exploit any regulatory gaps. Foreign analysts point to incidents in which crypto exchanges were compromised, cautioning that more mainstream adoption can sometimes lead to bigger, more glaring targets for cybercriminals. This tension between rapid innovation and robust security is a hallmark of the digital revolution. The question is whether the FSA's forthcoming blueprint has thoroughly accounted for these worst-case scenarios. In the official policy document, the formation of a dedicated working group is proposed, a collective of experts and stakeholders who will oversee the reclassification's practical rollout. This group is expected to analyze everything from corporate compliance to consumer protection measures. Part of the challenge, naturally, is that the speed of crypto innovation often outpaces the slow gears of legislative procedures. By the time new rules are penned, the crypto world might have mutated further. Balancing innovative agility with a measured approach is the tricky line Japan's officials must walk. Another subtlety is the recognition that tokens serve different functions. Back in the day, one might equate all crypto assets to the concept of digital cash. But the FSA's efforts to classify tokens by their economic role, distinguishing fundraising assets, labeled Type 1, from decentralized, non-fundraising tokens like Bitcoin and Ethereum, labeled Type 2, indicates a deeper understanding of the complexities inherent in this space. This functional classification forms the backbone of a more miscellaneous approach, ensuring regulations address the specific nature of each token. We can see how important it is for the new guidelines to keep a watchful eye on the horizon. The crypto arena moves so swiftly that a blueprint drafted today might be partially obsolete tomorrow, leaving open questions about how to handle entirely new categories of tokens or blockchains that have yet to be invented. Yet, if the FSA can remain nimble and keep its finger on the pulse of crypto's relentless evolution, Japan could become a model for other nations looking to craft their own robust frameworks. And this is where the contrast with other major economies truly stands out. To illustrate, let us consider the United States, which is engaged in its own labyrinth of crypto regulation. Different federal agencies have jostled for jurisdiction, leading to a complicated mosaic of rules that vary from state to state. On the other hand, the European Union's discussions around crypto have centered on uniform guidelines under frameworks like the Markets in Crypto Assets legislation. Japan, by contrast, has the advantage of a more unified approach, spearheaded by the FSA and shaped by an environment that respects future-oriented policy. If all goes as planned, the outcome could revolutionize financial accessibility for the average Japanese citizen. Imagine an everyday office worker browsing their standard brokerage account and discovering that they can invest in a cryptocurrency ETF, much like they would in an index fund tracking the Nikkei or the Dow Jones. This mainstreaming of crypto could yield a wave of new investment capital flooding into the space, driving growth in local crypto startups, tech talent, and even the broader development of blockchain solutions. Such a scenario might sound rosy, but do not forget that times of rapid change kindle anxiety and doubt. What if mainstreaming crypto leads to an asset bubble? We have seen that possibility in the past, with internet stocks around the turn of the millennium, for example, when excitement quickly morphed into a frenzy of speculation. Japan's regulators will be acutely aware of that risk and the importance of monitoring market conditions. One reason for measured optimism lies in historical precedents. Japan has faced notable financial turbulence, including the real estate and stock market crash in the early 1990s. Those experiences left policymakers more cautious than some other markets. Whether that caution translates into smoother waters for reclassifying cryptocurrencies remains an open question, but policymakers might view the new era as a chance to apply lessons learned in prior downturns to shape a more robust digital finance environment. Another remarkable trend to keep an eye on is the synergy between public sentiment and official policy. When the average person sees the likes of the FSA championing safer, more structured frameworks for digital assets, they may gain the confidence to explore carefully. Perhaps they will consider a small portion of their monthly savings or salary to dabble in a crypto ETF or even purchase a stablecoin from a local exchange. Over time, these small stepping stones could accumulate into a major shift in how society views the line between traditional and emerging finance. Still, all of these rosy developments hinge on how swiftly Parliament acts upon the FSA's proposal, the specifics of any amendments made, and the kind of reception from business leaders and the public. The next weeks and months are likely to be abuzz with further deliberations, stakeholder input, and possibly even protests. In some cases, certain political factions could object strongly, seeing digital currencies as an existential threat to the yen's sovereignty. Others may hail the moment as Japan's bold stride into an inevitable future. Our second call to action arrives just in time to keep your energies up. If the idea of a digitally fueled future in Japan excites you, Whether from an investor's standpoint, a tech enthusiast's perspective, or even just as a curious onlooker, consider subscribing to this channel. By staying connected, you will be among the first to hear about continuing developments, new proposals, and surprising twists in the crypto saga. These unfolding stories promise to be just as dramatic as any piece of fiction. You may be wondering at this point, will an influx of capital into digital assets overshadow traditional markets or erode the yen's status? Will pension funds and corporate entities move trillions of yen into crypto? Or will stricter rules and robust oversight turn Japan into an unrecognized utopia for digital finance, an oasis that helps nurse the entire crypto space to greater maturity? At this stage, speculation runs high, but one thing is crystal clear. Japan, driven by a blend of economic urgency and technological ambition, is forging ahead with a reclassification that could unlock new potential. The impetus behind the FSA's proposal resonates deeply with a global shift toward digital, intangible assets. A wave that has been building for years and only continues to gain momentum. As the concept of reclassification expands beyond headlines and into reality, do expect some turbulence. Volatility is a hallmark of the crypto world, and no regulatory measure, no matter how well crafted, is likely to eradicate that entirely. Yet, volatility also beckons opportunity. The reclassification might well become one of the most influential changes Japan implements in our era, bridging the old economy with the new. To wrap up, let us look once more at the heart of this narrative. The storyline began with the Payment Services Act, a well-meaning framework that once looked advanced but has recently become too narrow for the rapidly evolving digital asset world. Enter the Financial Instruments and Exchange Act, with its broader scope that treats crypto like mainstream financial assets. Under the watchful guidance of the FSA and armed with a supportive tax structure, the door is flung wide for new financial products, from ETFs to stablecoins to flourish. In the background stands the Bank of Japan, quietly reminding everyone that the future of money hinges on credibility and consistency. From small investors eyeing new opportunities to large-scale institutions eager to modernize their portfolios, everyone will be watching the next steps. If Japan successfully navigates this path, it may serve as a model for nations across Asia, Europe, and beyond, all of which grapple with the unstoppable rise of crypto. It is entirely possible that years from now, when digital assets are as common in a portfolio as bonds or foreign stocks, historians and market watchers alike will point to this moment as a decisive turning point. Stay tuned. The FSA's proposal, if and when adopted, stands to reshape not just Japan's economy, but could reverberate across the world. Some call it risky, others call it essential progress. Regardless of which side you land on, the story unfolding in Tokyo is poised to send waves through the global financial sphere. So keep your eyes locked on Japan, because the revolution in how we perceive, invest in, and harness digital value is unfolding in real time, right before our very eyes. And it may just reinvigorate the entire concept of money as we know it.